Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to Season 7 of Talking with Traders. We're now into the fourth year of this podcast since it started in early 2020. Once again, IG have come on board as our sponsor for this season. We are truly privileged and grateful to have such a global leader in CFD trading as our sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some will be follow-ups with past guests and some will be new guests. The idea behind this podcast is that you get a variety of views from a broad spectrum of market professionals. None of what you hear in these episodes is intended to be financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here into your own trading and investing. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified when new episodes are released. Once again, thank you to IG for funding and sponsoring this podcast into its fourth year. And thank you listeners for tuning in. Please enjoy Season 7 of Talking with Traders. Welcome back to another episode of Talking with Traders. This is Season 7 of Talking with Traders, and it's the second episode of Season 7. And my guest today is someone who I've really been excited to talk to for a very long time. His name is Tom Sosnoff. He has a very illustrious career in the markets, was Vice President of Trading at TD Ameritrade, founder of Thinkorswim, founder of tastytrade, tastylive, where he's currently involved. 2014 Entrepreneur of the Year in the US Midwest. The list goes on and on. But Tom, it's an absolute privilege to be speaking to you. Welcome to Talking with Traders.
I'm looking forward to it. Thanks.
Yeah, thank you very much. So, Tom, you've made a name for yourself in options trading, and you've kind of become the go-to guy for options trading in the retail market. Now, typically, options trading and retail market are terms that often don't appear in the same sentence. But yet you've managed to do it in a way that you simplify what is a very complicated part of the derivatives industry, I guess, and bring it to retail traders in such a successful way. I love watching what you do. From what I've seen of your work, it seems predominantly that you're generally on the side of selling options in order to collect premium. And almost like as an income strategy from what I've seen. I mean, you can correct me if I'm wrong with that. When you and I met in London recently at the tastylive event that you hosted there, you made a very interesting point that volatility and fear is typically overpriced or mispriced, and you want to be on the side selling the fear, selling the volatility, and that's kind of one of the hallmarks of your approach to options trading. Can you talk to us a little bit about that and just add some color to this idea of selling premium, selling options, selling volatility in order to earn income, and effectively that's how you profit from options trading?
Sure. And it's a very broad and obviously this is an expansive topic. But first of all, I think the most important distinction is I do not view selling options as a income strategy.
Okay.
So I think that's a very important distinction to make up front. I am a trader. I'm an opportunist. And I'm somebody that wants to put myself in a position where as a trader, I have the highest probability of success to make a reasonable amount of money. I do not consider that in any way, shape, or form income. I consider trading to be, I look at it as wealth creation. I look at it as, this is what I've been doing for, a little over 4 decades. Yeah, I built some companies in the process, and which I love doing, but the majority of my career, the majority of my life, I should say, I have spent in front of a computer trading. I still, like just before we're getting ready for this podcast, I was, flattening out a couple positions. I mean, I've been a little bit quiet today. I've only made, just under 40 trades this morning. We're about an hour into the day. So I'm still a hardcore junkie, and I don't view anything I do. I'm a risk taker, but I do it in a way where I feel like um, the most important aspect of what I do is I try to control everything I can control, meaning I control all my opening trades. Um, I am an option seller simply because I don't believe there's significant edge in selling options over buying options or any of that kind of stuff. I do believe there's a significant advantage of being right more often than being wrong, which I think option sellers are obviously right more than they're wrong because premium decays,
Yeah.
and therefore I put myself in a position to trade from strength rather than trading defensively. So I think that it's not a function of I'm giving myself, I am for sure, I have no theoretical edge. I mean, I know that if I somebody who's a seller and somebody who's a buyer, there's no theoretical edge one way or the other. But the person who's a seller is going to be right more than they're going to be wrong. They just are going to make, you know, potentially they're going to make less money when they're right and they're going to lose more money when they're wrong, and that's what evens out that risk reward. So but I prefer to be on that side. So it's more a function of where I see the highest probabilistic outcome, and that's how I view trading. I don't think trading is, in a traditional sense, trading has always been about, being right. Hey, I'm going to guess whether the stock's going to go up or down or whatever is going to happen next. Or, people have this massive, macro view of the world and all this other crap. I don't think about it like that. I think about trading as I'm a hardcore, you know, I'm a hardcore capitalist, but I'm an opportunist. And I view trading as, hey, markets are efficient, markets are random. I want to give myself the best chance to have the highest probability of success and manage my winning trades as best I can and use my mechanics to do that. And that's what I've spent the last, you know, 13 years at Tasty, just building basically mechanics. We've been building a think tank, um, and to support, like I don't care what kind of trading. Like you start off saying I'm an option trader, which I am, but I feel like I'm indifferent to product now. I don't care what we trade. Could be stocks, could be futures options, could be digital currencies. I don't care what it is. Like every market to me is exactly the same.
Okay. Okay. All right. Interesting. But I mean, just to keep on the options topic, I mean, and this is a stat that I've read, but it depends on which research you read. But that it suggests that around about 80% or more of options generally expire worthless. I mean, I know you guys have got data scientists working there.
Yeah.
You've probably got more accurate figures than I do.
That number that's an industry number that's fair. I don't think anybody would argue that. I mean, I don't know if it's 85, 83, 82, 73, whatever it is.
Yeah.
But just say 80. It's fine. Sure.
Right.
That's a good
Yeah.
number.
Yeah. So, I mean, to be on the side selling premium, then obviously that it naturally does give you a little bit of an edge if you believe that 80% of options expire worthless. What I want to ask you, though, is your approach to specifically around options. I mean, I know you said that you're
sure.
product agnostic and you'll trade anything that moves with the price, right? But from what I have seen of a lot of your work, it's quite mechanical in terms of the way that you trade, that you approach options trading. Can you maybe give us a bit of an idea from a high level perspective of the type of criteria you look at for setting up particularly a trade that involves selling options, be it any of the complicated strategies like an iron condor or a broken wing butterfly? I mean, there's some very interesting names for all of these structures out there, but I presume there are some basic criteria that you look for before you put one of these types of trades on, right?
Of course. And sure, I can easily walk you through some criteria that we use. I think the single most important thing when anybody is trading anything, first of all, the underlying has to be liquid.
Yeah.
One of the things that we do, and I should say what you've seen me talk about and how I talk to people that, follow us and watch our network and use our brokerage firm and stuff like that. The reason I present an incredibly mechanical approach all the time is because I just feel like there's so many people out there that just talk about markets in a very subjective, opinionated view of things that, to me, I I'll never forget a really great trader back in my early days of trading, and I had a really strong opinion on an underlying stock, and I talked to this trader, and he'd been around longer than me, and he was just one of the best traders in Chicago, and I looked at him after he made a trade, and I go, man, I really don't, I think that stock's going down. I don't like that trade. He goes, don't ever tell me what you think the stock's going to do ever again. Like in other words, he didn't care what I thought. And that stuck with me now for almost 40 years because I had this really strong opinion in my head about what this stock was going to do. And this guy was a great trader and he didn't care. He couldn't care less what I thought. And ultimately, the reason he was a great trader is because he didn't care what anybody thought. I have taken the approach to the next level with respect to Tasty. And I don't care what other people think about, what this stock's going to do, what the macro picture is going to do, what the market's going to do. And the reason I present a very mechanical, mathematical, practical, probabilistic approach to trading is because if somebody like you or anybody else out there wants to listen or follow our stuff, I want them to appreciate that I'm delivering math and nothing else.
Right.
Like I don't want you to care about what I think the market's going to do. Just like I don't care what you think the market's going to do. I want you to say, hey, that guy's interesting because he actually gave me a logical, mechanical reason why the math makes sense here. All the game we play, the derivatives game, it's all mathematical. It's all model generated. It's all just variations of Black-Scholes or some other derivatives pricing model. And so everything is just a number of plug-in variables. Everything we do. And that's why the markets are so good. That's why they're so efficient. That's why they're priced so accurately. And off of those variables, you can, get all this information, which we'll talk about later in this podcast. But for me, when I'm looking at making a trade, the first thing that pops up to me is I need that underlying to be super liquid, right?
Yeah.
That's the first thing.
Right.
You can't trade anything. There's no efficiency if there's no liquidity.
Yeah.
And one of the reasons that most people trade in America when they want to trade, options or futures options, that kind of thing, is just because we have the deepest, most liquid markets. And you need that liquidity to be an active trader.
Right.
That's number one. Second thing I look for is I equate opportunity with noise, and I equate noise with volatility. So the more volatility, the more noise, the more uncertainty for somebody else, the more fear, whatever you want to call it.
Yeah.
Therefore, the most opportunity. So number one, I want liquidity. Number two, I want high volatility.
Right.
Because with high volatility, you don't get a higher probability of profit. You don't get a higher probability of success. Sorry, I said that wrong. You don't get a higher probability of success. What you do get is the opportunity to make more for the same amount of risk.
Right.
So let's say I had a 72% chance of success in high probability and a 72% chance of success as defined by a math equation in low probability. In high probability, you'll make, let's say, $2, and in low probability, you make $1. Right. You're taking the same risk reward, same probability, but I want the opportunity to make $2, not $1.
Right.
So I want liquidity and high implied volatility. Those are the two most important, foundational aspects of trading for me.
Okay. All right. Super. Now, something else that I've seen from watching a lot of your work, in addition to those criteria that you've talked about now, is that you generally have a sweet spot in terms of the time, and I'm specifically referencing options and sold options here, where it seems you like to take trades where the time to expiry is 45 days or less generally. Can you talk to me a little bit about that and also the profit-taking strategy on these?
So the 45 days is a number that we came up with after a significant, literally thousands of hours of research, to determine where a in a option decay curve, like it's almost like a durational curve.
Yeah.
We're in an option decay curve, or we're over a certain period of duration. Do you have the optimal amount of premium decay with the least amount of gamma risk?
Yeah.
And that came out in the period from 45 days to 21 days. So a lot of our research, and I think this is pretty groundbreaking because it's the most important, I think it's the most significant kind of development in option trading, as far as for individual investors in a long, long time, is the perfect time to put on a trade is around 45 days. Perfect time to take off a trade is around 21 days. That gives you a set of mechanics. So you don't have to be, you don't have to be, everything's not completely like helter skelter all the time. And you put yourself in the best point of the decay curve to open trades and to close trades, or to adjust trades, or to roll trades. And in the process of doing that, the whole concept of managing early is essentially means you reduce all your outlier risk. You
Yeah.
basically eliminate outlier risk.
Right.
So that's why we've developed that whole scheme.
Okay. So that's interesting. 21 days. So you cut the trade back, take a profit kind of halfway through the duration to expiry. The other thing I've seen you do quite often is that is you look at the potential, the maximum potential profit on a trade, based on the potential premium that you could earn, and you bank that profit once you've earned about 50% of that potential.
Exactly. It's usually
So,
one or the other. Yes.
yeah, one or the other, right? So, but what I'm intrigued about is, why not run it all the way to expiry? I mean, obviously you've crunched the numbers and you've got, but is there, does your marginal benefit decline if you try and hold this position all the way into expiry? Or is there added risk by holding it all the way to expiry? Or why would you not?
There's added outlier. First of all, there's added outlier risk.
Okay.
And your P&L per day. So between 45 and 21 days, let's just say your P&L is X.
Yeah.
Between 21 and 0, your P&L is less than X. So you make less P&L per day, and you take more risk because your gamma risk goes up by double, triple, quadruple as you get closer to expiration.
Right.
So you take more risk, you make less money. So can you hold it? Of course you can hold it, but you make less money per day and you take more risk. So it doesn't make sense.
Yeah. Okay. And I guess over a number of observations, there's going to be some outlier that maybe,
of course,
wipes you on a trade like that.
These are all optimizations. These are all generalizations that we optimize, that we give you, like all we can do as both researchers and traders and people that try to, I mean, my goal is we give away all our content. Like, we don't charge for anything. We give away everything.
Yes.
My goal is to engage an entire generation of traders, and that could be ages from 18 to 88 or 98, whatever it is, and engage traders and give them a set of mechanics and optimize those mechanics. So looking at a option screen is intimidating to somebody that's never traded a derivatives product before.
Mm-hmm.
Looking at futures options, it's intimidating. But if I say, hey, futures options, listed options, they're the exact same thing, basically, mechanically. And then, hey, if you go look at options and I'm going to go look at 45 days, I'm going to go manage at 21 days, I'm going to look for liquidity, I'm going to look for high volatility. Hey, all of a sudden, I take out all these really difficult variables, simplify everything, and brings us back to one of the things that you said on the opening, which is, I think one of the things that we do better than anybody else in the world when it comes to finance is, or at least talking about finance, is we make incredibly complex financial topics simple to understand.
Yeah. And you do it very well, I must say. Having watched a lot of your shows, you really do dumb it down very, very nicely, so that it comes across simply. Just still on the point of being written on options, there's also the school of thought that being net written on options it can be very, very risky. And I want to talk to you about how you mitigate risk. Somebody once said to me, when when you're selling options, you eat like an elephant, you eat like a bird and you shit like an elephant, which I thought was, because obviously you're collecting small premium. If it goes wrong, it can go horrendously wrong. And but obviously there are ways to mitigate that risk. I guess one of those ways, first of all, is that you've narrowed it down to limited time frames. So you've naturally just limited the amount of time that you're exposed to the market, and that in itself mitigates some of the risk. But what else? I mean, I know structures like, for example, an iron condor involves, it's a written call and a written put, and then hedged out, well, protected, I guess, at the wings with a bought call and a bought put. But I mean, have you ever had trades like where you've been written and something's happened, some sort of a black swan event or an earnings report or corporate action or whatever comes along and completely destroys your trade, and you were expecting to make X, but you end up losing 10X?
The answer is yes, and it's happened to me probably more times than it's happened to anybody else in the history of trading. So of course,
yeah.
That's the nature of trading. I mean, you make a few million trades in your lifetime, you're going to have, your fair share of outliers, both for you and against you.
Yeah.
I have learned a lot in the last third of my career than, in the first part of my career, I learned a lot, about trading and everything. And the second part, we learned, I mean, every stage of my life and my career, I've learned more and more about different aspects of the business. But in the last, 13 years since we built Tasty, one of the things that I've learned is to trade smaller, because again, one of the things that you can control, one of the most fascinating things about finance is, if you think about it, one of the things that you can control is your size.
Yeah.
And if you keep your trade size small, a black swan event can never hurt you. The only thing that can hurt you in a black swan event is if your trade size is too big.
Right.
So the single most important thing about trading that I've learned is to keep your trade size small, because then a black swan event is irrelevant. It is the single greatest defense. The second greatest defense is to manage early, because there is no point in the last 40 years where early management of there is no trade date or no really point in all of trading where if you didn't manage early, or if you managed early, I'm sorry, let me say that right. If you managed early, you were not subjected to outlier moves. It's less than like a fraction of 1%. So we're talking about, like, we look at outlier moves as basically, let's call it outside of 2 standard deviations. But a true black swan is like, let's call it 5, 3, 5, 7, 10 standard deviations. There's only been 1 or 2 moves in the last 40 years where if you managed your trade early, you would have been subjected to an unquantifiable outlier move. I mean, obviously 1987, but that was even before we had skew, and maybe one other move since then. It just hasn't happened. So I do not worry about my positions ever, because I stay small, I manage early. Period.
And I mean, in terms of entry, do you look at earnings and things if you're trading a stock option? I mean, do you try and not be written over earnings, or does that not really matter to you?
I will adjust. It doesn't. Earnings coming up do not matter to me, but I will always adjust on the day of earnings. So, one of the things, first of all, I only trade liquid underlying. So that means there's only I trade probably, let's call it 200 different underlyings. Out of 4,000 stocks, I'd say about 2,000 are what I would consider liquid enough to trade. I don't trade anything other than those top 200 futures, stocks, whatever it is. And so if I'm in one of those positions, they have earnings coming up, I will look at my position, and the chances are, because they're liquid, I will either recenter on the day of earnings, or I will adjust the position on the day of earnings, or I will close. So I don't mind putting a position on before earnings, but I will adjust going into the earnings announcement that afternoon.
Okay. All right. So you'd prefer it has to have some sort of a hedge or something so that you're not necessarily exposed over the earnings report.
I don't hedge. I will adjust strikes.
Okay. I'm with you. Okay. All right. Super. Now, Tom, on your Tasty Trade, on your Tasty Live show, you've got a show called Fast Market, which
Yeah.
I find very interesting. I enjoy watching that. And that's where you receive trade ideas from your clients, from your followers, and you assess them live. And you've got an incredible knack for being able to analyze a trade and decide very quickly whether it's a good idea or not a good idea. You then put those trades on in most cases, from what I've seen.
Sure.
But from that, you've obviously seen a hell of a lot of what retail traders are looking at in terms of doing in their own trading. And from that, I guess you also get to see a lot of the potential errors that people make, amateur traders make with their trading. What are some of the most common mistakes that you see people making when they send in those ideas and you have to analyze them?
Well, when our customers send in ideas, they're usually pretty hardcore tasty traders, so
Yeah.
they kind of know, like, the direction, the kind of, strategies I like and things like that.
Yeah.
So that's why I trust them blindly, because I would trust our own viewers and our own customers way more than I trust any professional in this business. Believe me on that.
Okay.
But I have been around the block more times than I care to talk about, and I think, for me, I am, if I was to, well, obviously the simplest answer to what is the biggest mistake customers make, and the answer is they trade too big.
Okay.
I mean, you can talk about discipline, you can talk about, strategy, you can talk about lots of things, but the reality that that customers, the reality of mistakes that customers make is that they trade too big, and they do not understand, you know, some very basic things like allocation of capital, capital efficiency, and trade size. There are a lot of different ways to make the same type of trade. If you have a $200 stock, for example, you could tie up a lot of capital by doing something that's undefined, and you might want to make that defined so that you can use, a tenth or a 20th of the capital. And then if you're trading a $15 stock or a $20 stock, you might want to do it undefined because it's cheaper than doing it defined. So I think that an understanding of capital efficiency and how to use your capital, and also, I mean, the biggest mistake is trade size, but not understanding capital efficiency, not understanding, there's a little bit of nuance to products and trading, things like that. So I think, lack of know-how, but mostly trade size.
Mostly trade size. And I guess that comes back to that old fear and greed in the markets. And that's the greed component possibly coming out there.
People love, a lot of people don't like the grind. To be successful in trading, just like anything else,
Mm.
I'm I'm a law of large numbers freak, and you've got to do something a lot in order to, be able to recognize the opportunity in that, and a lot of people aren't willing to make that commitment, don't want to make that commitment. Also, a lot of people, love the idea of potentially, overnight success and things like that. It doesn't,
Yeah.
the truth is it doesn't really happen. There is no such thing as an
No.
overnight success. For every one person that does, 100,000 people don't.
Yeah. What's that
So
old thing I said, it takes 20 years to become an overnight success.
yeah, yeah. And
Yeah.
it's there's a lot of truth to that. And there's in our world, I and I understand this. I don't think people realize how efficient markets are and how difficult it is, to be successful. It's not impossible because the markets are so efficient. Every side has the same chance.
Yeah.
It's just it's how willing are you to make the commitment to, the industry, the space, whatever it is. And I just don't think, I mean, a lot of people just don't have the time or the resources or the energy, or the want to do
Yeah.
it.
Yeah. Yeah. It's all about a process. Yeah. Um, you've obviously got your Tasty Live show, which the channel, which is brilliant. You've also got Tasty Trade, which is your trading platform, which incidentally was bought by IG Markets in 2021 for $1 billion, if I'm right. And IG are the sponsors of this podcast, so I'm happy to mention that. In terms of the Tasty Trade platform, I want to talk to you a little bit about that, Tom. Personally, I've never used it, which is a little bit embarrassing, I guess. But I have traded on a number of other platforms. I obviously do trade through IG. I've traded through Interactive Brokers. I've traded through Saxo, a number of other platforms. Specifically, what makes the tastytrade platform special? And I'm asking in a little bit of a selfish way here, because I'm kind of thinking maybe in terms of my own options trading, I should be looking to set up an account there and give it a try. What are the spreads like? Because something I've found with trading options through a number of brokers is that the spreads are very wide, which make it difficult when you're particularly when you're selling options, trying to collect that premium. If the spread is extremely wide, then it kind of takes a lot of the meat out of the trade. So what are the spreads like on tastytrade? And then I've got another question following on from that is how many legs of a trade can you enter at one time in the order book?
Well, you can do 2, 3, or 4.
Okay.
I mean, we limit it to 4, not because we could go to 8 if we wanted to, but it's not. Nobody routes 8-legged spreads, so it's not worth it. It takes up too much space.
Yeah.
We're very focused on design and character space and things like that. So I'm going to back up to the beginning of your question. First of all, we are not we are not in the same business as IG. So IG is an OTC platform.
Yeah.
We are a listed platform. So we don't compete with IG at all. That's a completely separate. If you want to trade, if you want to trade CFDs or anything OTC or spot market, that's what they do.
Right.
We are different. We are listed only. So we are not the counterparty.
Yeah.
When you trade with IG, they're the counterparty. It's their platform. They're the counterparty. Everything else.
Yeah.
Which is fine. It's a different type of trading. We are a listed platform, and so we're just a facilitator. We're the go-between between you and the various products, whatever they are, whatever the exchanges are.
Yeah. So just to clarify that for the listeners. So I mean, if you're potentially trading on what CBOE, in any of the other listed options exchanges in the US.
Yeah, there's 11 different exchanges. You don't have to pick the exchange. We do it all for you.
Okay, so if I go onto tastytrade, I want to trade a structure. Let's just say I want to trade an iron condor. There's 4 legs to that.
Yeah.
I can go and price it all up. I can enter all 4 legs of that structure.
Yeah. Let me finish. I'll explain, because I'll make this simple for you.
Yeah.
So I just want to explain that's the difference between Tasty and IG.
Right.
Now we do compete with, for example, Interactive Brokers.
Yeah.
And when you look at the Interactive Brokers platform and the Tasty platform, I mean, that's who we compete with. Interactive Brokers, TD, Schwab, E-Trade, Fidelity, all those platforms. That's our competitive group. The difference is that I believe that we built the best option technology in the world.
Yeah.
We built the premier platform, which was called Thinkorswim. That was our last platform.
Yep.
And which is now Schwab's primary platform, but I built that. And we had sold that to TD Ameritrade, and then they sold it to Schwab. And then we built Tasty, which I think is the best, option trading platform in the world, even though you can trade stock, options, futures options, crypto, everything on it. When you asked about spreads, the spreads have nothing to do with Tasty. The spreads have nothing to do with Interactive Brokers or any other brokerage firm. None of us make markets.
Yeah.
We're all just route them. But the spread markets in the US now, the high frequency spread markets are a penny wide. Whatever you want to trade is a penny wide. So if you want to do an iron condor in XYZ, as long as XYZ is liquid, like let's say XYZ is Tesla, or XYZ is Nvidia, or XYZ is whatever else, you move it 1 or 2 pennies off mid price, you're filled.
Okay.
And in the futures world, you move it 1 tick off mid price, you're filled. So everything now is down to percents of pennies, fractions of pennies or pennies. And so the spreads are so tight, they've never been tighter. The average spread fill for us on Tasty, but it's no different than any other platform, just so you understand. It's not like Tasty we don't make better markets than Interactive Brokers. We don't make better markets than E-Trade. I mean, we are the only high frequency platform in America. So we're the only ones that have high frequency middleware, which means our platform could be up to 10 times faster. So instead of 250 milliseconds, we could be, 45 or 50 milliseconds, but it's all the blink of an eye. But we are lightning fast.
Right.
But that doesn't make us, we don't have better markets. We don't have better spreads or any of that kind of stuff. We may have lower commissions than other people, but whatever the case is, that that doesn't make us special. What makes us special is that we have built, we have the newest platform in the world for trading complex, complex option spreads or any kind of spread, future spreads or whatever you want to say. And the nice thing about Tasty is, regardless of your account type, regardless of where you are anywhere in the world, everybody can trade whatever you want to trade in whatever format you want to trade it. Like, in other words, we have multiple interfaces, all from the same look and feel, that allow you to trade any product, any strategy, in basically any market, any way you want to do it, with no restrictions, because it's your money. And we made it so simple to adjust, roll, to enter spreads. Everything is a single click, and
Right.
everything's drag and drop in a single click. And there's no other platform like it in the world. Like Interactive Brokers platforms, 20 some odd, 25 years old at this point. It's old. It's,
Yeah.
it's not, it's old, it's slow, it's clunky, whatever. TD's
Yeah.
platform, we built it. It was the best platform in the world until we built Tasty. It's old, it's slow, it's clunky, it's bloated, all that kind of stuff.
Yeah.
Tasty is, same thing with Fidelity, same thing with E-Trade and all those. Tasty is, it's lean, it's slick, it's not bloated, it's super fast, and it's conducive to trading. I mean, 80% of our business is options.
Right.
And then 10% is futures options, then 10% is futures. We don't even really do much stock at all. Even though
Okay.
stock is free on the platform, it doesn't matter to us.
Okay.
We are focused on delivering, the best option software in the world. That's all we do. And that's why you should be on Tasty. No
Right.
other reason. It's just that we make, like, you want to trade an iron condor? Great. Trade an iron condor on Tasty. You want to trade a skewed iron condor? Great. Trade a skewed iron condor. You want to trade an unbalanced iron condor? Great. Trade an unbalanced iron condor. You want to do it in multiple underlyings and futures or futures, everything sets up the same way, everything looks the same thing. We just made a platform that is super conducive to trading. The average person on Tasty trades over 1,000 times a year. The average person.
Wow.
So it's a
Okay.
very aggressive platform with respect to, we support traders. That's
Yeah.
it.
I'm sold. I'm sold, Tom.
Beautiful.
I'm going to go and open an account straight after this and give it a go. Fantastic. Now, we are running out of time, and I just want to I like to wrap these up on a slightly lighter note. I want to ask you, Tom, you're 66 years old now, and I know that because I looked it up on Wikipedia. You're a very energetic guy. What do you do in your spare time when you're not working so hard, and how do you keep such a high level of energy going at your age?
I don't feel old, even though I'm even though parts of me are breaking down, no question about it. I definitely have some broken pieces. But I'm a workaholic, and I don't have any hobbies, and I kind of live, every weekend or every other weekend I'm in a different city, giving a talk on option trading, and last weekend we were in New York City. 2 weeks before that we were in Texas. We were in Austin, Texas. 2 weeks before that, I was in. Well, you saw me this summer in London. I mean, I've been. Next week we'll be in, or I'm sorry, 2 weeks we'll be in Boston, and then 2 weeks after that we'll be in Los Angeles. It just keeps going. 2 weeks after that we're in Denver. I just keep moving. One, so I don't die, and two, because it's what I love to do.
Yeah.
And I don't want to slow down. I don't want to stop. Um, I'm way past, I do it for the love of the game. I'm way past doing it for the money at this point. I don't,
Yeah. Yeah.
I mean, I made my money. I love trading. And I think that I want my legacy to be, that we changed the world of self-directed finance in a way that it's never going back to the way it was before. And I work really hard at that kind of that legacy type mission. And I don't see myself, giving up on it. I hope I'm like one of those aging rock stars that just, keeps doing it in finance until,
like the Mick Jagger of finance.
yeah, that kind of thing. I hope we can do it into, my 70s and 80s. I don't want to stop.
That's
So,
magic.
and
Yeah.
if I can turn it over and basically hand the torch over to, young people like you and up and comers in the industry, that's really my goal, to make sure that the next generation, that your generation, is in a position to continue the mission, moving people away from passive to active.
Yeah, fantastic. Well, your passion certainly does shine through, Tom. Last thing is, I've got to ask you about the hat. I think that hat you wear is so cool. And it's become your brand. I mean, that is synonymous with Tom Sosnoff, and to the point where it's almost like no one else can ever wear a hat like that because it's your brand. It's a little bit like, Samuel L. Jackson's the only guy in the world who should be allowed to wear a flat cap backwards. And
Sure.
and that you're wearing is not quite a flat cap. I don't know what it is, but it's cool. It's very different. Is there a story behind that? Because it's certainly
No,
your
man,
brand.
I was getting into the crazy world of, I had been a trader on the floor for a long time. And when I left the floor, and I started building Thinkorswim and getting into the retail business, my hair was long. I didn't want to scare the children on Wall Street and that kind of stuff. So I figure I'll try this look. And it's kind of stuck with me for the last, 25 years. So I like it. It's kind of been my shtick. I don't really think there's anything more to it.
Yeah,
I don't think about it anymore. It's just part of the look.
it's
I'm
very
not your
cool.
typical Wall Street exec. So I think it's just, it's helped to separate me.
Yeah, well, it certainly has. It's certainly cool branding. Fantastic, Tom. Well, it's been an absolute honor and an absolute pleasure to speak to you. Thanks so much for giving up your time to come on Talking with Traders today. In terms of where listeners and viewers can follow you, I guess it's tastylive.com. Anywhere else that you'd like to direct them?
I'm on tastylive.com doing a live show every morning from 7 a.m. to 10 a.m. Central Time. We're Chicago based, so Central Time. It's our network's free. I also do a closing bell piece from 2:30 to 3 every afternoon on tastylive.com. I'm also travel all around, so you can see one of our live shows somewhere. tastylive.com/events. And if you want to drop me an email, I'm just Tom at tastylive.
Magic. Well, thank you so much, Tom. It's really been a pleasure. You go well. I know you've got a deadline now, so we're going to have to cut it here. But thanks again. It's been a pleasure speaking to you.
Awesome. Thanks so much.
Thank you. Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.